Value investing strategies are not for those investors looking to move quickly in and out of stocks on a daily or even an annual basis. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." When you invest in value companies, you must invest for the long term, and think in terms of years or at least months, not days or weeks. In fact, Buffett believes that all short-term price movements in the stock market should be disregarded by value investors, beyond using them as an indication of the best times to potentially pick up some new holdings. You should keep in mind that long-term investments are normally those that have lower risks. Rather than watching daily stock prices, you should spend that time keeping your eye on the operational performance of the companies in your portfolio. And rather than allowing market volatility to lead you into hasty and emotional investment decisions, you should continue to base your opinions of a company's value on facts. Sometimes it can take a company a long time to see its share price rise to match its intrinsic value. If you have the time, and if you won't need the money for many years, you have a huge advantage over investors with the opposite circumstances. You can buy, perhaps at a discount, when they need to sell. Good companies can trade at valuations that seem very low for years. This can happen when investors' attention is focused elsewhere, on hot tech stocks, for example, or when a sector is out of favor. Even if it takes several years to happen, the general principle holds. The market is usually efficient over the long run, and eventually, a stock's price will reflect the company's true value. If you've bought the stock at a discount, you'll make money, or a lot of money, if you sell it once its price rises to something closer to its intrinsic value. Having the patience to wait until that happens is one key to success as a value investor. So that's principle number 6. Make sure you have a long-term investment strategy in mind, and patience is key to your investment success. Okay, the final principle that you should keep in mind: know when to sell your stocks. Almost as difficult as knowing when to buy your stocks is figuring out when it's the right time to sell them. If a company is performing well, with no indication that its future growth potential has diminished in any way, then you can hold on to their stock until its market price exceeds its intrinsic value. Or in other words, you can hold your stocks until it becomes overvalued. Sometimes, however, stocks can become overvalued for the wrong reason, and this can be a warning that a severe crisis is in the works. The most common event that leads to a movement in stock prices is when companies release news about a new product line or management change. It can be good or bad news. If it's a positive reaction, the company's stock price will rise. If it's bad, the stock price goes down. Without question, the most important factor that affects a company's value, and therefore its stock price, is its earnings. Earnings are the profit a company makes, and in the long run, no company can survive without them. If a company's earnings are better than expected, its stock price increases. But if a company's results are worse than expected, its stock price will fall. Simple as that. Another factor is market volatility. Stock market volatility often leads to stock price declines across the board, even for companies with strong business fundamentals. Market downturns could be due to several reasons: changes in the economy, profit-taking after strong rallies, and geopolitical events. However, in such circumstances, stock prices may just decline temporarily, and chances are they'll recover in a few months. So you can take advantage of these scenarios to sell your stock at a high price and then buy it back at a lower price. It's a simple strategy for guaranteed profits. Another circumstance you should consider selling your stocks before everything gets worse is when the company suddenly cuts dividends without any acceptable reasons. As a value investor, we understand the importance of dividends, so you need to be wary when dividends are suddenly cut. 90% of the time, your stock price will plunge because investors no longer feel safe about their investments, and they're so concerned about the business performance. So, that's principle number 7. Know when to sell your stocks. In the next module, I'll teach you how to identify a company's economic moats so you can easily determine if a company has sustainable competitive advantages over its industry peers. Okay, see you in the next video. Hey guys, welcome to Module 3. In this module, I'll teach you how to identify a company's economic moat, as well as understand how wide it is and why it's so important. So what exactly is an economic moat? While regular cash flow, well-managed debt, and a competitive advantage all play a role in enduring business success, the ability to develop a wide economic moat is the key to what separates the winners from the losers over the long term. What we refer to as a moat is what other people might call competitive advantage. It's something that differentiates a company from its nearest competitors. In very simple words, an economic moat is basically anything that gives a business some form of built-in protection for its ongoing generation of cash flow. If you picture a company as a castle that is constantly under attack by its enemies or competitors, you'll have a better understanding of just how important an economic moat is in helping a business to thrive and survive in the marketplace. And here's what you should keep in mind when evaluating a company. Without one or more protective moats firmly in place, a formerly profitable business will soon find itself unable to maintain its market share, and its revenues will begin to drop off. This also means that a company without a unique economic moat can't survive in the long term. It'll be harder for it to compete with other companies within the same industry, and it'll be harder for it to recover from market downturns, recessions, or financial disasters. Remember that a competitive advantage is essentially any factor that allows a company to provide goods or services that are similar to those offered by its competitors, and at the same time, outperform those competitors in profits. So the easiest way to determine the size of a company's economic moat is look at its historical operating performance. To evaluate a company's operating performance, you can use some profitability and efficiency ratios. Then you can compare its ratio values with that of its competitors and the industry average. If the company you're evaluating maintains a better and more efficient operating performance than its competitors, it's clearly the winner, and you can expect that it will survive in the next decades. In the next video, I'll give you a complete list of economic moats that a company may have, and I'll also talk a little bit more about economic moats and why they're so important. Okay, see you in the next video. The concept of the economic moat comes from Warren Buffett. He evaluates a company's economic moats to determine its ability to maintain a competitive advantage over its rivals, and thus protect its long-term profitability and market share. So why do companies need a competitive advantage? A competitive advantage is any quality that enables a company to offer similar products to its peers while enjoying superior financial performance. Over time, companies are more likely to lose their competitive advantage because, as they grow increasingly profitable, competitors are more likely to replicate their methods or create even better ones. As soon as the level of a company's profits is significant enough to warrant attention, it opens itself up to attack from competitors who are looking to enter the marketplace with the intention of grabbing a share of those profits for themselves. This is exactly where a wide economic moat offers the protective barrier a business needs to prevent other companies from stealing its earnings. Or in other words, establishing economic moats can help companies protect their long-term profits. In reality, an economic moat serves as a competitive advantage over other companies within the same industry. But what sets it apart is the fact that the advantage is sustainable over a very long period of time. While these moats can be created in a number of different ways, and may be either narrow or significantly wide, it only stands to reason that the more of them a business can build, the better off it will be. Let me ask you a quick question. How can you feel confident about estimating a company's ability to generate earnings down the road if that ability is not protected in some way? You know, sustainability is the key to consistent and ever-growing revenues, and the economic moat is the key to that sustainability. While having a competitive advantage may allow a business to temporarily outperform its competitors, the economic moat is a benefit that's built to last, and it will ultimately determine whether a company is set up for prolonged success or inevitable failure. From an investment point of view, the longer a company's economic moat can hold firm, the longer you will benefit from its profits. It's important to be aware that there are some false business moats in the marketplace, masquerading as the real thing, and you should be careful not to be taken in by these imposters. Features like superior products, outstanding marketing strategies, and high-performance management teams are all wonderful attributes for a business to have. But on their own, they are not enough to provide a long-term competitive advantage. Products and marketing tactics can easily be copied, and so require the presence of a deeper, more durable barrier to support and protect them from would-be thieves. So make sure that you'll only invest in companies with moats that generate superior shareholder returns over the long run. And you should also be extremely selective and focused on wide moat stocks. Although economic moats tend to be more qualitative than quantitative in nature, there are a number of ways you can recognize when a company has one or more in place. A significant amount of cash flow and a strong operating performance are common to all businesses with an effective economic moat. But here are 5 other factors that play a vital role in the establishment of a sustainable competitive advantage. In this module, we'll talk about cost advantage, efficient scale, intangible assets, network effect, and switching costs, and how a company can utilize these wide moats to gain the upper hand over their competitors. In the next video, we'll talk about the first one, which is the cost advantage. Okay, see you in the next video. In this video, we'll talk about the advantage of having lower costs. A business that has the ability to sell its goods or services for less than its competitors will have a distinct competitive advantage in the marketplace. Naturally, the only way to accomplish this and still earn a profit over the long term is to be able to manufacture a product or provide a service at a lower cost than everyone else. This is often the case for larger companies with the resources to buy in bulk or to operate more efficiently for a lower cost. And also for those types of businesses that can be effectively located close to both the source of their income and to their customers, such as in the case of a local quarry. And here's a quick note. You'll want to look for companies with a cost advantage that competitors cannot replicate. Remember that an economic moat should be something that's sustainable and cannot be easily duplicated. This means that if you want your company to have a sustainable competitive advantage, you must make it hard or impossible for your competitors to copy your methods. Similarly, companies can do this by developing and patenting new technology before their rivals. So that's why when evaluating a company, you should also spend some time reading its quarter and annual reports to see if they invest any money in R&D. Companies with significant cost advantages can undercut the prices of any competitor that attempts to move into their industry, either forcing the competitor to leave the industry or at least impeding its growth. And companies with sustainable cost advantages can maintain a very large market share of their industry by squeezing out any new competitors who try to move in. You now understand the cost advantage. In the next lecture, we'll talk about the size advantage. See you in the next video. Besides having a cost advantage, a company can gain the upper hand over their competitors simply because it's bigger. Sometimes the sheer size of a company, in conjunction with the small size or niche-like nature of the market it serves, is enough to deter potential competitors and to serve as a wide economic moat. At a certain size, a company achieves economies of scale. This is when more units of a good or service can be produced on a larger scale with lower input costs. This helps reduce overhead costs in areas such as production, financing, advertising, etc. Big companies that compete in a given industry tend to dominate the core market share of that industry, while smaller players are forced to either leave the industry or occupy smaller niche roles. You know, when a company has a relatively exclusive monopoly, for example, it means it controls the supply of a particular product or service within a certain location or industry. This makes it very difficult for similar companies to get a foothold in the same market, since the established giant in the neighborhood has already claimed most of the available customers and has sufficient size and resources to do whatever it takes to hang on to them. In addition, when a company is big and it has lots of cash flows, it's much easier for it to grow by simply acquiring other businesses. A good example is Apple. For example, if Apple wants to develop a new headphone product line that will be used for upselling and increasing their lifetime customer value, they simply go out there and buy an excellent headphone business. And yes, they actually did. Apple bought Beats in 2014 for over $3 billion. And now they have great headphone products to sell in their stores without spending too much time and effort building them. You know, it may take Apple's competitors years to build the same headphone business. And of course, they'll have to do a lot of work. By having a size advantage, Apple is clearly doing better than its rivals. So, as a value investor, you'll want to invest in companies with a size advantage. In the next video, we'll dive into how a company can create an economic moat with its intangible assets. See you in the next video. Okay, in this video, we'll talk about the possession of unique assets. Another type of economic moat can be created when a company invests in developing and building its own intangible assets. Examples of such assets include things like patents, a strong and widely recognizable brand name, copyrighted intellectual property, and specialized permits or other kinds of government-issued licenses. These types of assets provide a natural economic moat for the company's continued and profitable business operation. Strong brand name recognition allows these types of companies to charge a premium for their products over other competitors' products because they offer customers something that's limited, exclusive, or difficult to replicate, as well as something that's often known for having a predictable level of quality. The perfect example might be Nike, which started out as a simple athletic apparel company, but has since become a major cultural institution and a purveyor not only of gear, but of status. Designer fashion labels have similar business models, using their prestige to sell clothing for prices several times higher than the cost of production. Not only does intangible assets help a company survive in the long run, they also help prevent other competitors from duplicating the company's products because they are protected by copyrights and patents. In addition, I want you to take note of this. Popular brands aren't always profitable brands. If a brand doesn't entice consumers to pay more, it may not create a competitive advantage. That's a red flag telling us that the management is not doing a good job to increase the business earnings and cash flow. From an investor's perspective, a popular brand means nothing to me if it's not profitable and if it doesn't show any promise for future growth. As an investor, what we care about is how we can make a return on our investments. If a business is not profitable, our investment won't be profitable, and we'll likely take additional risks of losing our money. So make sure you pick your stock wisely. In summary, you should look for companies that are protected by the advantage of a premium brand name, a tightly licensed product, a loyal customer base, and an industry with extremely regulated and complex entry requirements. And you also want to make sure the company's management knows how to utilize these intangible assets. In the next video, I'll talk about the network effect, which is another way an economic moat can be created. Okay, see you in the next video. In this video, we're going to talk about the benefits of the network effect. When a business has the built-in ability to both grow and improve as it gains more customers, it is said to benefit from the network effect. In these cases, the more people who use a certain business, the bigger its market share gets. But more importantly, the more exclusive its hold on that share becomes. This is simply because having more users translates into a more valuable product or service for all, and inherently leads to a never-ending cycle of continuous growth. The network effect is an extremely powerful type of competitive advantage, and it's most often found in businesses based on sharing information or connecting users together. You don't see it much in businesses that deal in physical goods. Examples of this can be seen in companies such as eBay, Visa, and Facebook. The more people who use these particular services, the better the experience becomes, which leads to more people using the services. The network effect gives a company a lot of advantages over its competitors. Looking at Facebook, for example, Facebook becomes more and more profitable when more people use it. You know what? Facebook has access to a database of billions of people around the world. So this means they can easily make billions of dollars just by utilizing their customer base. You see, the network effect makes it hard for other companies to compete with Facebook, because if they want to enter a competition, they must spend a lot more money on advertising and a lot more effort on reaching more people and showing their products. In the case of Facebook, they can reach billions of people without any hassles. You can guess who will win in this game. This competitive advantage can be difficult to dislodge once it gains momentum, and so it offers a potentially enormous economic moat to the lucky company or two that managed to establish the first successful networks in a particular industry. So make sure that you'll look for companies with a strong network effect. They are always winners in their industry. In the next video, we'll talk about how a company can create an economic moat by commanding high switching costs. Okay, see you in the next video. Okay, the final way a company can go about building a sustainable competitive advantage is integrating high switching costs into their business. Switching costs are expenses or disruptions a customer will encounter when switching from one product or service to another. It's beneficial for companies to create high switching costs, as doing so can help them retain customers. Cell phone service providers, for example, can lock in customers because of their high switching costs. To change providers, a customer might need to terminate an existing contract and purchase a new phone, both of which can be costly. As such, customers might be less motivated to switch providers, even if they're dissatisfied with their current service. You see, how well a company is doing is determined by its ability to maintain its customer and supplier base, regardless of how fierce the competition is. When a company provides a customer with a product or service that is difficult to break away from, in terms of cost, time, or convenience, it's far more likely to hold on to that customer over the long term. And this makes competition more interesting, because if the company's competitors want to gain more market share, they must offer an extremely attractive price or performance alternative to entice consumers to switch from their current provider. Their competitors will have a very difficult time taking market share away because of these cumbersome switching costs. You know, in many cases, customers just aren't interested in dealing with the fees or aggravation involved in making the switch, regardless of how appealing a competitor's offering is. Not only does this fact allow the company to maintain a strong customer base, it even makes it possible for them to incrementally raise their user prices over time, in order to consistently increase their profits. That is to say, when a company is able to establish itself in an industry, it can have higher pricing power over its competitors, and this is something that will help it survive over the long run. So, as a value investor, make sure you'll look for businesses that are industry leaders, and they know how to integrate high switching costs into their operating and marketing practices. In this video, we'll talk about the complete value investing roadmap so you'll know exactly your next steps and what you'll need to do to become a successful value investor. As you've already learned, by implementing the value investing strategy, you'll need to follow these 3 simple, easy steps. First, we'll look for companies with a strong financial and operating performance. What we want to do as a value investor is to make sure that the company we're investing in has enough capacity for maintaining its operations profitably, as well as having an ability or strong economic moat to compete with its rivals in the same industry. You can evaluate if a business is financially strong or not by looking at some financial ratios and performing a financial statement analysis. You'll need to look into your company's balance sheet, income statement, and cash flow statement to find out what's behind the numbers. And when you found a solid company, the next step is important. You'll need to make sure that it's undervalued. You can easily determine if a stock is undervalued or overvalued by performing a stock valuation based on some method like the discounted free cash flow model. After estimating a company's intrinsic value, you simply compare its intrinsic value with the current market price. If the intrinsic value is greater than the current market price, the stock is considered undervalued. And on the other hand, when the intrinsic value is lower than the market price, the stock is overvalued. It's simple as that. And always make sure you'll apply a margin of safety to make sure that you'll actually buy an undervalued stock. However, knowing a company's intrinsic value is not enough. That's because you'll need to find the best opportunity to buy it. A great company can easily end up being your worst investment when you buy it at the wrong time. And that's why technical analysis is essential in your value investing system. By utilizing technical analysis, you'll know exactly when to buy your stock to maximize your profit while reducing your risk. And the final step is sell your stock when it becomes overvalued. Again, you can determine the best time to sell for maximum profit by using both stock valuation methods and technical analysis. So that's the 3 simple steps you'll need to follow. Now, let's talk about the roadmap for mastering the value investing technique. I've been a value investor for 7 years now, and here's what I've learned to become a master. To become a profitable value investor, first and foremost, you'll need to learn all the best value investing strategies to find solid and financially strong companies to invest in. That is to say, you'll need a system. You'll need a set of investment criteria for evaluating and picking undervalued stocks. By having a system, you can make sure that all the companies you choose are rock-solid companies, and you can easily automate your stock analysis and valuation process. You can either build your own system or simply follow our copy and paste value investing system. After knowing all the strategies that actually work, you'll need to enhance your expertise so you can understand better all the businesses that you're investing in. You'll need to learn more about financial ratios and how to read and analyze a company's financial statements. If you were an accounting or finance student when you were in college, you might have gotten familiar with these topics. But if you're not a finance person, learning these topics may be a little bit harder for you. But they are essential if you want to be successful as a value investor. So learn it well. Next, you'll also need to learn more about stock valuation. At least you should master how to use the discounted free cash flow model, so you can project future cash flows of a company and estimate its intrinsic value. And when you're done with the intrinsic value, things will become much easier. Your next step is to use technical analysis to determine the best time to buy and sell your stocks. By using technical analysis, you simply look at a stock's chart and determine current market trends and predict the future movements of your stock. You'll need to look at some technical indicators and oscillators like the moving averages, the RSI, the Bollinger Bands, volume, the MACD, etc. And you can also look at chart patterns and candlestick patterns so you can predict if your stock's price will go up or down in the future. And the final thing, you'll need to develop a strong winning mindset and learn about trading psychology. You'll also need to know what affects the price of your stock, how to trade at minimal risks, how to reduce risks on your investments by placing a stop loss, etc. So, that's everything it takes to become a profitable value investor. You know, value investing is a big subject, and it does require some kind of expertise, a lot of work, and patience. But you know, value investing will eventually pay off. I promise you that. Imagine you can grow your investments by at least 15 to 25% a year by just following a simple system that you can create on your own. That's much easier than putting your money somewhere else, like in the bank or your 401k and IRA that generally pay you nothing in return, or a small fraction of the return you could have made. So, welcome to the value investing world. I believe you can do whatever it takes to become a better investor, and you can change your financial future.